I'm going live, huh? Now putting
Yeah,
on.
yeah. Yeah.
Good morning, subscribers. Today we have Mr. Yogesh Patil, Chief Investment Officer, Equity from LIC Mutual Fund. LIC Mutual Fund's parent is the Behemoth Life Insurance Corporation of India, LIC, that we all know. Today, LIC manages more than 34,000 crores of assets, out of which about 13,000 crore plus is into equity assets. Yogesh Patil is Chief Investment Officer Equity at LIC Mutual Fund with over 22 years of experience in the mutual fund industry. He joined LIC Mutual Fund in the year 2018. Prior to that, he has worked with Canara Robeco Mutual Fund for about 9 years. Patil has an MBA Finance from Symbiosis Institute of Business Management, Pune, and he earned his BCom from Government College, BHEL, Bhopal. Welcome, Yogesh, to our channel. Thanks for accepting our invitation to share your knowledge with our subscribers.
Thank you very
Namaste.
much, sir, and good morning, everyone.
Yeah. Good morning. Good morning. So, your parent is one of the largest, companies in India, I would say.
Yes, sir.
And LIC public issue was overwhelming a couple of years ago when it came. Almost everyone subscribed. So throughout the breadth and length of the country, people know about LIC. So you have a such strong parentage. And tell us about LIC Mutual Fund and currently what is happening in the fund house. Just to give some brief intro to our viewers, you can talk in plain, simple English so that people can understand.
Yeah, yeah, definitely. Thank you. Sir, LIC is basically very well-known brand and is a trusted brand in India actually, and is known but is known for insurance. And LIC Mutual Fund is a subsidiary of LIC, which is one of the oldest, but not seen a traction in last 20-30 years. Just I think things are changed after 2013 when Nomura took the stake and Nomura exited in 2016. And you see the new journey started in 2018. And from that day, promoter is really serious. They realized ki, oh, what we missed in last 20 years. And suddenly they started accepting lot of changes in the company. Like they started market hiring. Our whole team is coming from market. Today, if you ask me, except our CEO, which came from LIC parent, except all are actually market lateral hiring or market driven hiring. Actually. So that shows the commitment from parent as well as and when we need basically capital, the promoter is really helping us. We recently acquired IDBI Mutual Fund, and promoter has actually supported this move. And actually, in future also, our target is to increase our AUM, and that's one of the reason. If you see the in last 6 years, we see the sharpest jump in our active equity AUM, and we are ready for growth. And over last I think 4 or 5 years, our increasing branch network across the service level is improved, and we're reaching the client. We invested in investment team, and we again hugely invested in IT, basically IT, IT business, sorry, IT portion. So where the digitalization and the customer should get a seamless benefit of our services, and in same time, we want to cash on our brand because LIC stands for trust in India. And considering the LIC brand, the LIC mutual fund is slightly underrepresented in terms of potential, but we are very sure in coming years, we'll try to make up this gap and try to improve the investor experience and their comfort.
Good, good. I mean, one thing I heard from you is your parents should support you, or the investor, the largest investor, which I think LIC holds about 42% in LIC mutual fund. So when promoter is ready to be with money, that is the raw material for any business. Of course, AMC business also. So that is good to hear that the largest parent, largest insurance company in India is supporting you, and you want to grow, and I can see that. I can see that the assets have grown in the last few years tremendously. So now coming to the topic, generally market is on a roll, continuously, going up. The two post elections, after the central government, assumed power, took charge, the current prime minister took charge. It is on a roll, going up continuously. Investors are happy, but at the same time, they are also nervous. When will this end? Why markets are going up? What is
Yeah.
your thought on this? Why markets are going up?
See, if you ask me, generally equity market function like a democratic process, where investors are with varied risk return expectations, different levels of greed and fear, and different holding periods.
Mhm.
All participants and express their view and reaction. When markets or stock goes up, investors enjoy returns, but also worried about losing profit. It's a general phenomenon of greed and fear, which is short-term thinking because of volatility in the market. And
Mhm.
is this is due to largely news flow or maybe liquidity. If investors increase their investment horizon or maybe time frame, then volatility will reduce, and also reduce the feeling and the fear in the market. But if you ask me, these are the two coins, and uh, temperament is also very equally important in investment, because every day it's judging you, every day new news flow, liquidity drivers, and new ideas coming for investors. So one is obviously the incremental growth will only coming from earnings, right? But at same time, we need to have patience. We need to faith in our thought process. Then only investors can enjoy the ride. Or he keep if someone is forgetting fundamental and actually following the short-term news flow, which is liquidity, or maybe which increase the volatility, then it could be painful in short term. That's what we
Okay.
believe.
But generally, I mean, when the markets are going up, for it could be due to various reasons. It could be due to liquidity. It could be due to opportunities or
Yeah, yeah.
increased flow, cash flow. Whatever fundamentals. Of course, economy itself is growing up. Which are all the factors that are positive for India right now?
So the biggest, the India, lot of factors, not one or two. See, first start with the macro part. Indian government done a fantastic job keeping the tight fiscal deficit, tight control, controlled inflation, controlled current account deficit basically, and this gives an overall stable in macro environment. At same time, government see today India is a right mix between politics and policies,
Mhm.
and our working age population, which we call demographic dividend, is the highest in the world today. India have almost 19% of the working age population of the world today, but it is underrepresented due to poor manufacturing output. At the same time, it gives a opportunity and the future potential. It looks to be very high India, and incremental growth for India actually we believe is completely driven by capex, manufacturing, and consumption. So the longevity of growth also matters because it increases your terminal growth. At same time, investor also need to keep the faith in their thought process, or maybe in India, because there would be some setbacks, geopolitical issues, and then historically all these things seems to be a very temporary, according to me. And every 2 3 years you might be seeing some minor, on every 6 7 years many major issues, but eventually market is completely driven by earning and potentials, is proven again and again.
Over longer periods, so people need not worry because it will be driven by fundamentals.
Strong fundamentals, strong
Yeah,
fundamentals.
yeah, sure, sure. I mean, as per your opinion or fund house opinion, I would say,
Mm.
so what do you feel right now? Is the market overvalued or fairly valued or undervalued? What is your thought process I mean, because you are managing 35,000 crores,
Yeah.
the fund house, so you will take a call. That's why.
See, definitely valuations are very dynamic and valuations are relative to other variables. Means we should consider whole environment while reaching conclusion on valuations. So first to understand what drives the market, what drives the valuation basically, right? Liquidity, earning growth, and valuations. And we are in the middle of cycle. If you take the example of, let's take a Nifty, which is trading approximately 21 times of FY26, and the EPS is roughly 1250 rupees. And we need to consider interest rate part, which is roughly 6.9% today. And interest rates are coming down, and equity valuations are inversely proportional to interest rates. Interest rates goes down, valuation goes up. I'll give a very basic calculation. If you see the study the over previous economy like Japan, Taiwan, and we seen East Asian crisis, they all bubble have busted because of the completely stretched valuation, considering their liquidity environment, right? So today, 10-year GSEC is trading at 6.9. If I give zero growth, and if I ask the what is the PE of that bond, which is roughly 100 divided by 6.9, which is roughly 14.5, right? If any Indian government bond is trading at 14.5 valuation with zero growth, right? And obviously, equity investors should get an extra reward. It means
Mhm.
equity risk premium. So, what is the risk premium? If I take it earning growth for Nifty for let's take a next 2 year CAGR, it could be roughly around 9%. If I add 2 year average, right? But 25 from 25 to 26, right? And if
True.
I adjust the inflation, which is RBI last year was 5.4, and the RBI estimate is recently is 4.4. So if you deduct that 4.4 adjustment to the inflation, you'll get a figure of roughly 5, approximately 5 or 4.5, something 4.5. And if you add it in risk-free return, like 6.9 plus 4.5, you'll get a somewhere around figure of roughly 11.4, 11.3. And then what is the equity expected return? The equity expected return is basically your 11.4 return expectation divided by 6.9, which is roughly 1.65 or 1.67 times of the 10-year GSAC. The expected equity return in terms of 10-year GSAC is 1.56, 1.6 or 1.7 kind of number. And what is the bond valuation currently? The trailing bond valuation is 14.5. If you multiply it by, let's take a 1.7 year, what you will get figure? You'll get a figure of roughly 24 times or 25 times.
Mhm.
So considering liquidity in the system, considering the earning growth, considering the valuation, we don't think Indian markets are overvalued. It is a fairly valued. We still have room, but if you keeping other variables constant and market is going up, then is overvalued. If interest rates coming down, let's take a 6%, then definitely the 21, 22 times can be easily go 25.
Okay.
We
Okay.
need to measure it. If we as a fund house, if you ask me, we will be worried if in equity valuations trading more than 2x of the 10-year GSEC valuation.
Okay.
Then it will cause a worry. It means valuation going one way, stretching, and without any calculations.
Okay. 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 Understood. Understood. Well taken. Because there are a lot of sound in the market that markets are shooting up. There is overvalued, undervalued. All those things people used to hear. So
That's
that's
true.
why I asked your fund house view, and you have given a very analytical approach, which
Mhm.
stands good generally. I mean, it is not your emotion, it is our sentiment or your thought. It's a very analytical parameter that you have given. That gives a clear picture. And now coming to the topic point, how long this bull run will continue? I mean, there is all because since COVID, people are, I mean, except for 1 or 2 years, here and there, of course, ups and downs are there. I do agree. But the people are sitting with good profits. And as I said earlier, they are afraid, they are nervous, they are happy. So one of the points which people like to know is how long this bull run will continue.
Is again
I mean, I'm not asking,
no, no, I got it, got it.
I'm not
Again,
asking
it's a very
number
good
of
question if
years.
you ask me,
Yeah, any number of
because
years.
I'm
But
facing
you
this
can say
question a
certain
lot of times.
parameters.
Yeah.
As long as these parameters can continue, the bull run will continue.
Yeah, definitely. So as I highlighted, we are in basically middle of cycle, right? And Indian growth story seems to be a very long term, more than 10, 15 years. And the optimism about Indian equity is based on anticipated economic growth due to capex, manufacturing, and consumption. And it's largely driven by working age population, favorable government policies, and while there could be temporary setbacks or maybe issues of the market correction, like in past, but long-term outlook for market is bright because again, is a market is a basically relative valuations, right? Is not a standalone. And if you see the fiscal deficit or inflation or indirectly macro part, look at every country, like developed countries, even third world countries like Pakistan, Sri Lanka, and Bangladesh, they're nowhere, right? And if you ask me economic map, the some of the countries doesn't exist today. They are
Yes.
in negative zone today. So, and at same time, Indian government maintaining a good relations with all countries. So this will improve the relations slowly because of the de-dollarization. Our crude import, considering our IT export services, actually matching us. So current account deficit is in control, fiscal deficit is in control, macro is in control. India is in one of the best spot because of the our population, right? Especially working age population, where you can expect some output and consumption.
Mhm.
So
Mhm.
longevity of the bull run is very high today because the cycle is very big. Uh, because working age population is only available in India, so incremental manufacturing or incremental benefits coming indirectly, directly coming to India in form of FDI, trade partners, and relationships. When the dependency of India will increase, definitely their approach to India is completely changed. The relationship will be better, and that gives India and us is a confidence. India is the only country where we see a growth because of all these factors.
Okay, okay, good, well taken. So, there is good chances of, this growth, economic growth continuing as long as the government favorable factors, market environment continues, then the bull run will continue. I mean, positivity,
Yeah, yeah,
except for the short-term
that's true. That's true.
breakdowns. Yeah, I do agree. And, one of the reasons for arranging this conversation today, from my side is some of the LIC mutual funds schemes are, topping the charts, coming up very good, and you are giving a very good return to investors. It could be your small cap, your mid cap, your multi cap, infrastructure. Many of the schemes are
Mhm.
showing up in the charts. So, and what is the, reason behind these improved returns in the recent past?
Okay. You are absolutely right. Our fund has experienced notable improvement in recent months. See, is a combination of lot of things. Just go back 3 years back after COVID and after Russia-Ukraine conflict, the global economy went with a significant reset basically and realignment of trade dynamics, and the requirement is completely changed, and that creates a space or opportunity for certain sectors, and that contribute to our fund performance, and we taken it very uh, basically what we call openly and spreadly. We spread all these opportunities in different funds, and we recognize the emerging potential and increase our position in basically pro-cyclical sector and emerging themes such as manufacturing, capital goods, CDMO business, data centers, auto ancillary, engineering, and power. And anticipating these sectors would outperform as global and domestic economies gain momentum. Because of Russia Ukraine, there is a shortage of fuel, especially gas, that went up, and then again most of the fuel, including crude and coal, going up, right? And at same time, in last 15 years, no country has invested in basically thermal power and mining, and because of poor progress in renewable energy. So that has caused everyone shock. If you ask me, increasing digital economy, it means you need a more and more power because you need a more and more data centers because of regulation, because the regulator want the data should be in the country. Point number one. Second, the cost of power is going up everywhere except India also, and that in data centers more than 90% cost is power. So all these the basically major capex driven by demand for power, demand for defense and indigenization, demand for railways actually, and is followed by electronics and other sectors. So all these government policies helping us and realize there is a gap, and we still think these sectors can drive more than 5 6 years because incremental growth in India is not because of government wants, it is a need base because we need so much of data centers. So today the data center is actually growing by 30-40% kind of growth every year. The
Mm.
same with it's supported by power equipment, power transmission, renewable requirements. All these actually driving the India growth story. And at the same time, government focus on domestic manufacturing and reducing dependence on other countries, also improving manufacturing in defense, railways, and some of the higher end chemical business, specialty chemicals, pharmaceutical business, and new and basically the CDMO business. So all these sectors actually contributed to all our funds, and we taken a selectively calculated approach as per the fund mandate, and which we think is a true to level where the investor is ready to take a risk.
Okay. Okay. So if I could understand in my own way, so you are getting into those sectors, which are not, very big from a market capitalization perspective, like banking or IT. Of course, you will be entering there as well. But you are also looking into other sectors, like capital goods, where the size of the companies are smaller, which are contributing majorly. They are market leaders. So some of those sectors in capital goods, manufacturing, and all those things, which is driving up your performance. Am I right?
Yeah, yeah, you're absolutely right. So we normally try to invest where the earning growth could be higher than nominal GDP,
Okay.
and the longevity and the visibility of earning growth, some visibility in earning growth and their potential, and they are leaders in their category basically.
Okay. Okay. So well taken. So, best wishes on that. Congratulations on, many of your
Thank
funds
you.
performing well. And what are the sectors that you think, as a fund house, that are currently undervalued?
Mm. Sir, at this point, I won't say it is undervalued, but some of the sectors not performed in last 2-3 years, like private banks, chemicals, IT, and consumer, and but they shown some improvement in last 6 months. But still, in terms of fundamentally or maybe business wise, they need to show some more improvement. And considering I am very confident that the economies grow, then all these sectors will contribute. And IT sector again depend on the US basically, US elections and or maybe up to some extent US interest rates. So these are the, if you ask me, valuations wise, actually not given that much of return. Is it, you can say, is underperformed compared to broader market or indexes.
Okay.
So here, undervalued stock, finding undervalued stock is very difficult, but everyone has their own definition of undervalued.
I do agree. But general underperformance is seen in private banks, IT, chemicals, and consumption. Am I right?
Yeah, yeah, yeah.
Yeah, just to sum it up. That's all. So then one of the thing is, you are currently you have come out with the NFO, new fund offer, in the manufacturing team.
Yeah,
So, and it is right now open for subscription.
that's true.
Uh, could you, brief about that manufacturing fund?
As I earlier highlighted, incremental growth for India will be completely driven by capex, manufacturing, and consumption, right? And the manufacturing is basically is the end of infrastructure. Because I'll differentiate. Sorry, I will bifurcate three parts of in infrastructure. Basically, one is asset creator, asset owner, and asset users. So manufacturing is a basically asset user part, right? So we believe manufacturing is emerging as a key theme with tremendous growth potential in India, and it is a multi-decadal story. Currently, it's a hardly 17% of GDP and not grown in last 10 years. If you see as a percentage of GVA, is still lowest, right? And it has to grow. And we already seeing a positive impact on various sectors, including electronics. Electronics export went up by almost 3x in last 4 years. Defense export went up by almost 2.5x in 4 years. So, and pharmaceutical chemicals, they are incremental business coming from US actually, and there every company is looking for a capacity expansion because of the China plus one, Europe plus one strategy, and India's growing consumption and government focus toward reducing imports. More manufacturing will come to India, and this is a very good growth story. And we expect a multiplier effect on job creation, technology types, overall, and this will contribute to economic growth, and this will itself driving the further leg of growth in manufacturing, because India's availability of working age population make it one of the largest provider of human resources.
Mhm.
So incremental, let's take we calculated almost one. almost 179 million uh, workforce will only available in India for next 20 years. There is, except most of the countries except US, Brazil, rest of the countries seen a major decline, especially China. Their working age population is coming down and actually started coming down since 2021, and because of their one child policy. So incremental workforce is only available in India. Today we have a very good working age population, almost 19%, and manufacturing is hardly 3% of the world actually, and we are export is hardly 1.9% in manufacturing, basically non-gold, non-oil. So any country want to reduce the dependence from China. Any country want to move the work from their country to, let's say, some other countries like India, to for I think to reduce the in anticipation of lower non-availability of workforce and higher inflation, because India is the only country where you see availability and affordability of workforce. Second, availability and affordability of the energy cost. Third is basically realignment of supply chain, which is called deglobalization. Everyone want to reduce the dependence from China, so everyone is looking for India. Fourth is important, US, Europe, because of they're also struggling with their working age population, aging population, and a high inflation. So incremental, even higher end job like partnering the research with manufacturing, they are also those kind of combination also coming to India, and Indian economy itself is growing at healthy pace. So these are the major five drivers for manufacturing.
Manufacturing. Okay, generally, fund houses like you come out with the NFOs when the future potential for generation of returns is higher. So, do you think that manufacturing is also at the crux of growth going forward so that people can make decent returns from your offerings?
Yes, we believe in long run the manufacturing could be growth driver for country like India, and we seen in last 3 years government has done all kind of work would need for any manufacturing company, right? Today is I think if you ask me, the right mix of policy and politics. First time in India where most of the state governments competing each other for inviting corporate world, right? 20 years back there was very different scenario. First thing. Second thing, we also getting a favor from global players and global companies because of China plus one, Europe plus one, and Russia-Ukraine war actually created a much more opportunities today, if you ask me.
Okay.
And I think now you could have asked me why not 2 years back, 1 year back, but we were waiting for most of the policies and confirmation, our internal calculations, where we see most of the multinational companies increase their capacity 2x, 3x, and they actually want to do real good business in for next 10 or 20 years. For sourcing, they are getting a business from parent, they are getting a incremental business from export. It means their addressable market is actually increasing, right? To take care of the global demand actually.
Mhm.
I'll give one more data here. Total manufacturing fund AUM is 35,000 crore of late, roughly, and the
Oh,
many
industry,
yeah,
industry.
industry in mutual funds,
Okay.
and the value of manufacturing last year was roughly 32 lakh crore, which are
Oh,
expected to grow. So, and in last 5 years, more and more companies coming with a equity. It means that incremental capex is happening through equity capex, not a debt capex. Nobody's borrowing for capex today. Most of the good companies actually raising equity. It is a healthy sign. It means investors are ready. They are also confident about growth, and the market is actually supporting that part.
good, good. And in your portfolio construction in the manufacturing fund, will you be focusing more on small cap or mid cap? Do you have anything towards that?
Yeah, definitely. The large part of the manufacturing opportunity is only available in certain sectors
Mhm.
like engineering, capital goods, CDMO business, specialty chemical, and these sectors are largely available only in mid and small cap.
Okay.
So coming to your point, we largely invest in emerging companies or maybe high growth companies where we see high growth. At same time, we also make sure uh, on valuation part, because today the market, considering the growth potential of India, we should not ignore the terminal value of the business. It means longevity of growth, right? So P is a two dimension, which is price divided by earning, which is 2 year. But if you added growth, it's a three dimension. It means one should also consider the growth part if someone is not considering the terminal value. So we take a peg approach here and high growth companies with some visibility in earning in terms of capabilities and leadership in their particular area.
Okay, okay, okay. Good luck with your NFO anyway, which is ongoing, but also good luck, and best wishes as a fund house, for your AEM to grow. Probably we will allow 5-10 minutes for questions. Now, if there are any questions, I mean, I'm done with my thing.
Yeah.
So probably subscribers, if they have some questions, probably we'll allow a few minutes so that I will moderate. Just a minute. Give me a second. Just a minute. Some people are typing. And one of the questions from my side is, the infrastructure. I think you run an infrastructure fund as well.
Yeah.
So infrastructure fund, the capital goods sector, that sector will it keep growing, or it has, because in the last 2-3 years it has done drastically well. So
Yeah.
will that continue, or there chances to continue, or will there be any blip?
See, considering last 3 year return, now I won't say is we need to reduce our expectation, return expectation. But if you ask me, is it again a multi-year story? I'll give one data. Today, the gross fiscal capital formation of India is roughly 92 lakh crore, right? Out of 50% is private and government capex, which is roughly 45-46 lakh crore.
Mhm.
For next 6 years, the government and private capex combined would be not less than 90 lakh crore. It means what we are talking is tripling of government and private capex from till date. So what we done in last 50-60 years, so we can actually triple or more than I think 2.5x in next 6 years. So this gives enough confidence to me. It's completely driven by power, railways, defense, and powers, data centers, PLI schemes, and others capex from chemical and pharmaceutical. So
Okay.
and again, I earlier highlighted is India is a capex manufacturing and consumption driven story, and you figure out some of the companies for next 20 years.
Right. Okay. 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 Good, good. Yogesh, I think probably we are coming to an end with that, and we will meet up whenever you are in Chennai, next time.
Definitely, sir.
Thanks for your time on a weekend, because usually we conduct this show on a Saturday, 11 a.m., so that more people can view this and they can utilize this opportunity to ask questions, directly with the CIO, CEOs, and all those things. Anyway, thanks for participating. Appreciate your time for on behalf of our subscribers.
And thank you very much, sir, for hosting me on
Thank
your channel, basically. And at the same time, all the best to you also.
Thank you. Thank you. Thank you. Just let me wind up here.
Thank you.